No, but seriously, what's going on with Bitcoin? On February 5, 2026, Reuters reports Bitcoin down 12.6% at $63,525 after printing an intraday low of $63,295.74. In the same 24-hour window, roughly $1 billion in Bitcoin positions were liquidated, and the global crypto market sits in a drawdown so large it has erased $2 trillion of value since the early October peak. Now look at the split that matters. CNN Business reports Bitcoin falls below $63,000 for the first time in 16 months, down roughly 50% from its October peak, while gold blows past $5,500 an ounce in a record rally. That divergence is not trivia. If you treat Bitcoin as digital gold, your protection plan breaks the moment fear arrives and Bitcoin sells off like a high beta tech stock. What if everything you believed about Bitcoin as a safe haven was wrong? This isn't a story about crypto being volatile. Volatility is the symptom, not the mechanism. The mechanism is simpler and more unsettling. When real-world stress rises, markets decide which assets absorb fear and which assets become collateral to sell. This unfolds in 4 stages. Stage 1 is liquidity expansion. Stage 2 is narrative adoption. Stage 3 is correlation reveal. Stage 4 is forced deleveraging. Throughout the last century, every major speculative asset followed this exact sequence. This isn't prediction. This is pattern recognition from decades of market structure and crisis behavior. Stage 1 is liquidity expansion. Credit is easy, leverage is tolerated, and the cost of carrying risk feels low. Stage 2 is narrative adoption. A story arrives that explains why the asset is different, why it's inevitable, why it belongs in every portfolio. Stage 3 is correlation reveal. The asset's independence gets tested under stress, and it starts moving with the same crowded trade it was supposed to hedge. Stage 4 is forced deleveraging. The selling stops being optional because margin calls, withdrawals, and risk limits turn beliefs into liquidation. To understand where Bitcoin is right now, you have to stop asking, is crypto up or down? You have to ask, what is Bitcoin being used for in the plumbing of markets? Because in 2026, Bitcoin is not just a coin. It is a collateral asset inside a leverage ecosystem linked to ETFs, derivatives, lending desks, and retail portfolios that rebalance under stress. When the cycle reaches stage 4, the question is never which asset is best. The question is, which asset gets sold first? Historical case study 1 begins with the global financial crisis. It is the cleanest modern example of how safe haven is not a label you can declare, but a behavior markets impose. The Federal Reserve's historical summary of the Great Recession notes that the S&P 500 fell 57% from its October 2007 peak to its trough in March 2009. That number matters because it captures the moment when risk assets stopped being investments and became liabilities. In that environment, investors didn't sell what they hated, they sold what they could. In 2008, funds and institutions were forced to raise cash, and the first phase of crisis selling hit broad risk exposure. The second phase concentrated into whatever still had bids. The pattern is always the same. When balance sheets fracture, correlation goes to 1, and liquidity becomes the only religion. And in those windows, gold behaves differently than almost everything else because it sits outside the promise structure of financial intermediaries. Not because it is magical, because its role is understood globally, across regimes, across crises, across centuries. The lesson is not that gold always goes up. The lesson is that when fear becomes systemic, markets reach for instruments that carry fewer counterparty questions. And anything that looks like collateral inside a leveraged system becomes a candidate for liquidation, even if the story says it's a hedge. Historical case study 2 is March 2020, when the world discovered what liquidity shock actually means. On March 12, 2020, as global markets seized, multiple post-mortems describe Bitcoin dropping more than 40% in a day, and briefly trading below $4,000 during the worst of the stress. The same pattern, same stages, same outcome. The timeline varied, but the sequence never changed. The narrative said Bitcoin would hedge chaos. The market treated it as a source of cash. At the same time, central banks rushed to stabilize funding markets, and the global system pivoted toward what it always pivots toward in emergency: the deepest, most trusted liquidity. In plain terms, when portfolios are bleeding, managers sell what's liquid, what's volatile, and what triggers risk limits first. That is why safe haven status is not earned in bull markets. It is earned in crisis, when everything else is forced to sell. In March 2020, Bitcoin didn't fail because the code failed. It failed the safe haven test because the market structure around it was levered, thin, and reflexive. When leverage meets fear, the asset becomes a valve. Pressure escapes through the most crowded pipes. Bitcoin was one of those pipes. Historical Case Study 3 is the modern crypto credibility fracture, 2022. In November 2022, FTX filed for Chapter 11 bankruptcy, and news reports tracked Bitcoin trading around the mid-$16,000 range during the collapse. That episode wasn't only about fraud, it revealed something structural. The crypto ecosystem was not a separate island. It was connected to leverage, to credit, to rehypothecation, and to institutional risk appetite. 3 systems, 3 different triggers, identical 4-stage cycle. And each time, the defining moment is stage 3 becoming stage 4. Correlation reveals itself, and then selling becomes forced. That is what markets are signaling in early February 2026. Now bring the framework forward to the present day, with actual numbers and named institutions. As of February 5, 2026, Reuters reports the crypto market has lost $2 trillion in value since the early October peak of about $4.379 trillion, with roughly $800 billion wiped out in the last month alone. Reuters also reports Bitcoin liquidations top about $1 billion in 24 hours. And notes Bitcoin is down 28% year-to-date in that same snapshot. That is stage 4 behavior. It is not a debate about narrative. It is a measurement of forced repositioning. Meanwhile, gold is doing what fear flows demand. Multiple reports describe gold recently breaking above $5,500 an ounce and setting record highs in late January, before violent pullbacks and rebounds. The key is not the day-to-day wiggle. The key is that gold is where fear is being stored, while Bitcoin is where fear is being monetized. CNN Business frames the heart of it. Bitcoin's slide is happening during a period when geopolitics and market stress would normally fuel a safe haven rally. Yet Bitcoin is not coming along. That is the divergence. That is the warning. Now add the policy layer that most people misunderstand. Treasury Secretary Scott Bessent testifies that the Treasury has no authority to stabilize crypto markets, cutting directly against the assumption that a policy backstop exists for digital assets. This matters because modern markets are not only priced on fundamentals, they are priced on what investors believe will be protected in a panic. When a backstop is explicit, risk appetite expands. When a backstop is denied, risk is repriced immediately. That denial lands on top of a liquidity story. Reuters reports analysts pointing to expectations that a more hawkish Fed leadership posture could shrink the Fed's balance sheet, and markets are sensitive to that direction. The Fed's weekly balance sheet data shows total assets around $6.606 trillion as of February 4, 2026. That number is not just a statistic. It is a boundary condition for global liquidity. Bitcoin has widely been treated as a beneficiary of abundant liquidity. When markets begin to price a world of less liquidity, speculative assets get repriced first and hardest. Reuters also reports institutional ETF flows turning negative, with Deutsche Bank analysts pointing to U.S. spot Bitcoin ETF outflows of more than $3 billion in January, following about $2 billion in December, and about $7 billion in November. When institutional flows reverse and liquidity thins, price moves become faster, sharper, and more reflexive. This is not a moral statement about Bitcoin. It is a mechanical statement about market plumbing. And it changes what you should do with your own expectations. If you're in your 20s or 30s, this affects you because high volatility drawdowns can collide with life decisions, job insecurity, and forced selling at the worst moment. If you're in your 40s or 50s, this affects you because rebalancing pressure rises when retirement allocations are stressed, and Bitcoin exposure can amplify portfolio volatility right when risk capacity shrinks. If you're retired, this affects you because sequence of returns risk is unforgiving, and large drawdowns can lock in losses if withdrawals are forced. Some will say this time is different because ETFs and institutions make Bitcoin mature. The data shows the opposite under stress. When markets flip to risk off, Bitcoin trades as a risk asset, and the safe haven flows go elsewhere. Now add one more layer because it reveals the hidden feedback loop. Michael Burry writes that extreme volatility in gold and silver can be connected to crypto stress, with the idea that certain participants sell metal-linked positions to manage crypto losses. Whether you agree with the framing or not, the mechanism is real. In a multi-asset leverage ecosystem, losses in one pocket force liquidation in another pocket. That is exactly how Stage 4 spreads, not through headlines, but through margin. Bitcoin is being used as sell material in that chain, then it is not acting as a hedge, it is acting as a transmitter. So where are we in the 4 stages right now? Stage 1 already happened. Liquidity expansion built the runway. Stage 2 already happened. The narrative of digital gold and institutional adoption reached mass distribution. Stage 3 is visible in the divergence. Gold absorbs fear. Bitcoin sells off with risk. And Stage 4 is visible in the liquidation prints, the ETF outflows, and the speed of the drawdown. Now the question becomes forward-looking, and it has to be framed carefully. This isn't fear. This is preparation based on historical precedent. Over the next 12 to 24 months, 3 warning signs matter more than any price prediction. Warning sign 1 is liquidity conditions. If the Fed's balance sheet continues to trend lower and funding conditions tighten, speculative assets remain vulnerable, regardless of narrative. Warning sign 2 is structural flow. If ETF outflows persist at multi-billion-dollar monthly rates, the marginal buyer weakens and rebounds become more fragile. Warning sign 3 is forced seller risk. Watch miners, highly levered traders, and companies with crypto-heavy balance sheets because forced liquidations can turn a correction into a cascade. The market already showed you a preview on February 5, 2026. $1 billion in liquidations in 24 hours is what reflexivity looks like when leverage is still present. None of this requires you to believe Bitcoin is dead. It requires you to accept that Bitcoin's role in portfolios must be described honestly. In geopolitical stress, gold is being treated as a fear sponge. Bitcoin is being treated as risk to reduce. If your plan assumes Bitcoin hedges systemic fear, you are exposed to the exact moment you bought it to survive. The adjustment is not complicated. It is psychological and it is structural. Separate long-term conviction from short-term function. An asset can be revolutionary and still behave like risk-on in a liquidity squeeze. Size exposures so you never become a forced seller. Stage 4 destroys investors who are right eventually, but levered at the wrong time. And if you hold Bitcoin through vehicles that can gap, close, or reprice sharply, treat drawdowns as portfolio events, not headline events. The cycle doesn't care about your belief. The cycle responds to liquidity, leverage, and policy expectations. Here is the core thesis, in plain terms. Bitcoin is failing the safe haven test of early 2026 while gold is passing it, and the divergence is the signal. The hidden mechanism isn't crypto volatility. It's the market's decision to treat Bitcoin as risk-off sell material, while gold absorbs fear flows. And the policy layer matters because Treasury leadership is explicitly denying a stabilization backstop for crypto markets, forcing a repricing of implied protection. You have a choice. Understand the pattern and position accordingly, or ignore it and hope this time is different. But remember, this time is never different. The timeline changes, the sequence does not. If this analysis opened your eyes, subscribe now. In my next video, I'll show you the 3 portfolio stress tests that reveal whether your hedges are real before the next liquidation wave makes the choice for you. The liquidity shift is coming. The only question is whether you'll see it before it arrives.